I made a video the other day talking about how to identify important levels when learning to trade. And I thought I'd make another one to unpack it a little bit more, give you a little bit of a visual representation that I think will help explain it a little bit easier. Because this really is, one of those basic fundamentals that you've got to master in order to become consistently profitable in your trading. And like I spoke about in a previous video, the importance of learning the fundamentals will carry forward into your trading journey, which ultimately will be cut short if you don't master these basic fundamentals, one of which I'm going to talk about today. So I believe this to be the most important of those fundamentals, and it's how to look at a chart that you may be interested in trading and try to understand what the insiders are doing, what the where the large volume of activity is taking place, the strategic volume, because these big institutions, they don't trade for the short term or for the short term time frame. Their job and their only job is to generate revenue, and the only way to do that is to cause prices to trend up and trend down. And so how do they do that? Well, let's talk about the mental model I was talking about. So all of you are familiar with a house. A house is constructed with, we're not going to talk about a single story house. We'll use a 3-story house. Excuse me. 3-story house is an example. And imagine that house with the face off, where you can see right into the house. And you've got, the bottom floor, the second story. Some people refer to that as the first story. It's kind of like when I came to the Midwest, people referring to lunch as supper, and that always cracks me up. I'm like, no, it's lunch. They're like, no, it's supper. Or sometimes they refer to dinner as supper. I'm like, well, lunch is lunch, dinner's dinner. I don't know where supper came from, but anyway, little Midwest trivia there. So anyway, getting back to this house, we got a 3-story house. We'll call it the first level, the second level, and the third level. And if you can imagine, off to the left-hand side of the house, you've got price action. You've got bars on your chart that are, stepping down, like a waterfall. From a higher point, coming down into that bottom floor. And when it gets to that bottom floor, it bounces, and then you'll get some price action going up. It'll come up to that ceiling of that bottom floor, and sometimes it'll go right through it. Most of the time, it'll pause there, maybe retrace a small amount, get a little bit of sideways action on your chart, depending on what time frame you're looking at. And then when it continues to trend up and goes through that ceiling of that first floor, what was the major support level on the floor of the bottom floor, and resistance being the ceiling of the bottom floor, when it goes through that ceiling becomes the support level of the second floor. and that becomes an important level. And then prices will move on up, and they can continue to do that. I mean, you could have a 10-story building, but we're using a 3-story building as an example. You know, they continue on up. They come to the ceiling of the second floor, maybe retrace a little bit. Again, maybe get a little bit of that sideways action. And then the market pushes on up through that ceiling of the second floor to the third floor, and that previous resistance area, that ceiling on the second floor, becomes the support of that third area, of that third floor. You know, and then it typically will retrace again. And by this time, you're starting to get you know, the public coming in, the average retail traders, the ones that are seeing, oh, there's some moves that have been happening, and I don't want to miss out, so I'm gonna jump in here. And that drives that price up into that ceiling area of that third floor. And this is where the insiders, this third floor area is where the insiders, the big money, they're selling. They're selling their holdings that or their positions that they accumulated coming down into the bottom floor at the very beginning of the example. So they're selling to you. They're selling to me. They're selling less to me these days. I usually catch them on the second floor. But nonetheless, they're selling to the public, retail traders. And, you know, this is where you'll see that shooting star pattern candlestick pattern that I talked about in a previous video. And you know, that what does that candlestick look like? It looks like it has a small range body at the bottom with. Sorry, I had to pull over and delete a couple videos off the camera. I ran out of space. But this is where you'll see that shooting star candle usually show itself. You know, I talked about this candle in previous videos. This is also commonly referred to as an upthrust candle. What it looks like is, you know, it's got a small range body at the bottom of the candle with, you know, a pronounced longer wick at the top. And what does this signify? It signifies that, you know, it doesn't matter what color the body is because it's a smaller body. You know, it could be black or it could be white. You know, some charts that's red or green, differentiating whether or not the candle closed higher than it opened or lower than it opened. So what this candle tells you is that, you know, the candle opened at the beginning of the trading session, and prices were pushed up quickly or over the course of that trading session, and then at some point reversed and came back down very close to where it opened for the day. And that candle signifies weakness, and you know, the power of that upthrust comes from, you know, all of the retail traders and public jumping in to that particular market, you know, out of fear of missing out of a larger move. But like I said, you know, that candle really signifies weakness because the insiders or the large institutions, that's where they're selling their position size, and they're selling it to the public. So we're at that top area of the third floor, and then when that price turns around, it'll go back down to the floor of the third floor, which is, if you'll remember, is now a support area from when price broke into that area on the way up. And sometimes it'll go right through it, depending on the power of the move going back down. And why does it go down? It's because, you know, the insiders are liquidating their position, the public's buying it, but the insiders aren't buying it. So there's way more supply at that level than there is buying interest. You know, and when people are trying to jump in quickly, they're jumping in with market orders, and you know, they can get caught in a tumble down before their orders even filled. So, you know, that's how the insiders, you know, they've got to get back down to that ground floor, and they have the ability to do it by the sheer size of their holding and their capital. So price gets down to the ground of, or the support level on that third floor, and it may, you know, retrace back up a little bit, and then you know, continue on down through that support level to the second floor, and now that support level becomes a resistance area, or the upper limit of the second floor. And the same thing will repeat itself, you know, on down to the ground level. You know, and of course, things don't happen as cleanly as that once it gets down to the first floor, where things just automatically turn around. You know, sometimes it'll continue on down further. What you're really waiting for is for that lower candle to appear. You know, so as price action is coming down, you got those candles stepping down into that waterfall again. That waterfall, you know, looking candle setup, where you've got, you know, it's like a staircase. It's coming on down, and it's on a higher time frame. It's really easy to spot. But before that next house structure builds, you know, price has got to come down to a level that the major players, you know, want to accumulate more, want to accumulate a new position size, and you know, it'll come down, and you know, one of the candles that I look for, it doesn't show itself every time, but one of the candles that I look for, you know, is a hammer. Now, what is a hammer? You know, a hammer is a candle I described in a previous video. Kind of signifies weakness of a downtrend, and it's an area that insiders start to accumulate a new position. A hammer looks like the shooting star candle that I described, flipped upside down, where you've got a small range body at the top with a long pronounced wick going down. And what this candle tells you is that when the market opened, when that session opened, you know, prices moved down, and then before the end of the trading session, they reversed and started going back up, and then closed at an area close to where it opened. And you know, what that shows you is that's an area where those insiders, like I said, are accumulating a new position. And then the process repeats itself. You know, you may have a period of, during that period of accumulation at the bottom, depending on what time frame you're looking at. On a daily chart, you could have a bar or two. You know, signifies a couple of days. On a weekly chart, it generally shows itself as one bar. But as you go down in time frame, you know, you get a lot more noise on the chart. So, you know, that sideways consolidation could look more pronounced, you know, like on an hourly chart. But what's really going on right there is, you know, large institutions accumulating a new position. And you can think of it as, you know, as a business that sells something. You know, they've got inventory, you know, that they've got to get rid of, So they put it on a shelf and it starts to sell. And they're going to test out how much they can sell it for, and they do that by increasing the price. And that kind of correlates with that uptrend that I'm telling you about. And they're going to reach a point where they raised it all they could. Supply is starting to dwindle. It's becoming more scarce. There's fear in the public that they won't be able to buy whatever's being sold on the shelf, and they start buying it up quickly, and that allows the store owner to continue to raise the price. But at some point, he's going to run out of inventory of that particular product, and he's going to need to replenish his warehouse so he can keep an active supply on the shelf. But he wants to buy it at wholesale prices, so he's going to place an ad, and he's going to offer to buy it back, and people are going to be happy to sell it back to him. If he creates a little buzz around another source of supply that's going to be coming available at lower prices. It could be from a competitor, and people that bought it at that higher price that wanted it are going to want to buy it at that lower price when it's available. So they'll gladly sell it back to that shop owner, and that's what causes that price to go back down. So that accumulation phase on the bottom is that store owner acquiring new inventory to sell to his customers. And then how do you identify if the market is in a trend? Because one thing you're going to hear is a saying, the trend is your friend. And you'll have folks that trying to teach you something or trying to sell you a course, and they'll say, look, if you look at this chart, you can draw a trend line, as the price is going up on the bottom of the trend, and on the top of the trend you got this nice channel, this nice price action channel that's going up. They could be describing it going down as well, and it's very clear and plain to see on a chart after the fact. When you're trading live, it doesn't work like that. You don't see those channels in the moment because they're developing. So how do you tell if you're in a trend? Well, go back to that house example I was explaining about. Let's talk about when the price went up to the third floor and then came back down to the first floor. And as it got down around that first floor on that downward move, the price that you're looking at is going to hit a bottom. And typically it's with let's use the hammer candle as an example. You hit a bottom with that hammer candle, and that's that low spot, and then price will, when price bounces off that level and it goes up, and it finds the next short-term high, and then comes back down again. You've got the first 2 points on the beginning of that channel that they're showing you, or they described as so easy. Buy at the bottom of the channel, sell at the top of the channel. But when you're trading live, when that channel is first developing, you don't see it. So, and then by the time you do see it, as a new trader, you're looking to get in, at the end of that channel, which on a uptrend, that would be that third floor. And then you run the risk of getting stopped out as the market turns over. So that's how you tell if you're in the beginning of a trend. You get those first two data points, that bottom low, that first high as the price came up, and then the price comes down and makes a newer low. And depending on if the second low is above the first low, if it's above the first low, you would be looking for confirmation that price is going to continue to move up, so it's in an uptrend again. And if it comes down to where it's below the first low, then you would be looking for that next move up to be lower than the first move up. You should be able to gain a mental picture of what I'm describing, and and that's how you notice a trend that may be developing in the beginning. And like I said when I was talking about the house, I typically am getting in on that second floor, and that's how I do that. That's how I think a lot of experienced traders do it. So couple little points there. These are two very important fundamentals for you to learn about, test out, back trading, which I've got a number of videos on my channel talking about back testing. Explains in great detail. That's a way to take a trading strategy or an indicator or a couple of indicators that you're thinking someone's told you about or you've learned about, or you want to see how accurate they are over time in the whatever commodity or stock it is that you're looking at. How you test it out, because really the most important thing for you to focus on is your education. You're in a learning phase right now. You're a ninth grader, first day of high school, and in order to graduate, become a consistently profitable trader, you've got to learn the fundamentals of trading. The money will come, believe me. You can do very well trading, but you got to learn to be patient, be consistent in your application of your trading strategy. Once you've gathered enough education to where you can interpret, what you're seeing for yourself, so that you're not dependent on someone telling you what to do. You're not trying to subscribe to one of those newsletters that give you all the free picks. You want to learn how to fish. That's how that old saying goes. I think it goes something like, teach a man how to fish, teach a person how to fish, and they'll never go hungry. Give a man a fish, he's dependent on you to continue to give him a fish to survive. But you teach him how to fish, catch his own fish, he'll never go hungry. Same thing in trading. Learn the fundamentals. Spend some time on the fundamentals, and I'm not talking about a week or a weekend or you read one book and you've mastered it. You've got to apply it. You've got to test it out, and you do that without real money. You do it in a simulated account. You can paper trade. You can back test. Like I said, watch some of my previous videos that will walk you right through it. Pretty simple. And that's what'll give you the confidence, to enter the market when you see these repeatable entry signals show themselves, on the chart. And man, guys, it's that easy. know, if you let yourself get overrun with emotions, you know, you're afraid that you're going to miss out if you don't get in on something that you're seeing, or, you know, that's the biggest one right there, the fear of missing out. And what's driving that? It's greed. You know, markets have been around for hundreds of years, and they'll be around tomorrow and for another 100 years. So don't force a trade. Wait for the next one. You know, get in the market on your terms. Understand where you're going to get out of the market. And if you get stopped out every now and then because, you know, things just don't go your way, that's just the way it goes. That's the uncertainty of the whole game. And trading is a numbers game. It's a game of probabilities. The fact that you've got a trading strategy, or you're looking to develop a trading strategy, all that does is give you an edge. All that does is increase the probabilities in your favor. But you know, at the end of the day, anything can happen. So learn to detach yourself from the outcome. If you get stopped out in a trade, you know, chalk it up to the cost of learning. It doesn't define you. Don't get hung up on it. Don't start to look to change, you know, your trading strategy to adapt. You know, if I would have done this differently, you know, I would have won. No, don't do that. That's a recipe for disaster. Chalk it up to the cost of doing business and wait for your next trade setup. It's a much less stressful venture when you approach it that way. So anyway, hope you enjoyed the video. I certainly am enjoying making it. Hope you got something out of it. You know, drop me a comment if you got something you want to talk about or need me to explain a little bit further. You know, I'd be curious to hear where you guys are at on your journey. You know, what you're thinking. I'll help in any way that I can. You know, those of you that are watching these videos, you know that, you know, I'm just a normal guy. Goes to work every day, like I'm sure you're doing. It's found a way to make money in the market, and I'm trying to explain it to you. So, you guys have a great day. I'll see you on the next clip.